So today I want to talk about the Federal Reserve, and I want to talk about the new outlook, the new consensus outlook that was published, and that consensus includes all of the members of the Fed that are in Constitution Avenue in Myron Scholes building in Washington, D.C., plus all of the Fed presidents who provide their estimates. But before I do that, I want to talk about inflation in the US, where it's come from and what the cause is. And the reason I'm going to do that is because I read a lot of commentary, particularly by aged journalists working from the Australian newspaper, blaming the Fed for inflation. But I thought I'd talk about where it actually came from, and where it's come from. And this circumstance has nothing to do with the Federal Reserve and everything to do with budget deficits. And we can learn about the causes of it by comparing the size of the budget deficit in the US in 2020 and 2021 compared to the size of the GDP gap. That is to say, the excess resources available in the economy because of very high unemployment in 20 and 21, plus excess capacity in industry. And these estimates of GDP gap are provided to us on the Federal Reserve database website, and I'm using that, and I'm going to compare that to the GDP numbers, the GDP deficit numbers that are also on the website. What we find is that the GDP gap was at its greatest back in the second quarter of 2020 when it was 10.77% of US GDP, so the Fed tells us. And at that time, the Fed tells us that in that year, there was a budget deficit of 15% of GDP. Now, if you provide more stimulus than there is excess capacity in the economy, what is going to happen is the excess, the amount of stimulus minus the GDP gap, that extra stimulus is going to go straight into the increase in nominal GDP, which means all of that is going to go to inflation. So what happens in 2020 is as there is a GDP gap of 10.77%, and there's a budget stimulus of 15%, and so 4.25% of that goes to an increase in nominal GDP. It goes straight to inflation. Okay. So what happens the next year? What happens is we have the American Rescue Plan being introduced by the Biden administration. And a year later, in the second quarter of 2021, the GDP gap has already fallen to a very small 1.7% of GDP. But in that situation of this very small budget deficit, where the economy is pretty much fully recovered in GDP terms, the Biden administration adds the American Rescue Plan, which it provides an additional deficit of 12% of GDP. And that means that 10.3% of that stimulus goes to putting up not real GDP, because there isn't enough gap in real GDP to push it up, but nominal GDP. It goes straight to inflation. So of that 12% of GDP in the American Rescue Plan, much of it, when I've looked at it, is handouts to democratic states to get their government superannuation programs back in order, or long-term handouts, which have nothing to do with COVID, to the public sector education unions, which have been great supporters of the Democratic Party in the presidential election that's just happened. So of this deficit of 12% of GDP in the American Rescue Plan, 10.3% of that goes directly to pushing up inflation. So that's where the problem of inflation is. It's budget deficits, not the Fed. So have that in mind when you read people blaming the Fed for the current inflation. So, but what we got last year out of all of that was very strong growth. GDP growth in the US was 5.7%. And what the Fed expects is that this year that's going to fall to 2.8%. Next year that'll fall to 2.2%. And the year after that, that'll fall to 2%. And both of those are still above trend numbers because what it says in the longer run growth of the US economy that's sustainable is 1.8% of GDP. Whether they get that number from, that's the combination of population growth plus productivity growth in the US is 1.8%. That's higher than a whole lot of countries in Europe. It's way higher than, for example, Japan, but not as high as Australia, where we're about 1% higher than that because our population growth on average is about 1% faster than in the US. Unemployment, they expect this year to fall to 3.5%, down from about 3.8, which it currently is, and be 3.5% next year, 3.6% the year after that. In the longer run, they expect that to be about 4%. So they think what that means is they think they can get target inflation with an unemployment rate of only 4%, not much higher than it is now. They think that this year that PCE inflation, the personal consumption deflator, is 4.3%. That's what the Fed thinks. I think the CPI in the US this year is about 6.2 now. That's higher than the number that I had in the quarterly. But I'm revising up those numbers based on what's been happening since I wrote that quarterly. Next year, inflation, both on the PCE and the CPI, should be about 2.6%. And in the long term, it should be about 2. Core inflation, about 4 this year in terms of the PCE, but drops down to 2.6% next year and 2.3 the year after. So they're pretty close to target by next year and the year after. So what do they do with the Fed funds rate? And this is what's really interesting when I compare what their expectations are in comparison to what my model in the quarterly says. So what my model in the quarterly says is the equilibrium short rate for the Fed funds rate should be 1.89%, and they publish a consensus of all of the members of the Fed think that their Fed funds rate at the end of this year should be 1.9%, pretty much exactly the same number. Now, why is that interesting? It's particularly interesting because my model is driven not so much by inflation, but where unemployment is, and the kind of wages growth and core inflation you get from where unemployment is. So I think what's happening in the Fed is they're using the same kind of a model to use their estimates of where unemployment is to generate where wages growth is, to generate where they think the core inflation will be. And that's what they're using to determine where their Fed funds rate should be. So based on that, where they think the Fed funds rate should be is they think it should be 1.9% at the end of the year. That's a rate hike at every meeting, but there's something else that, apart from that I'll talk about in a little bit. They think that the Fed funds rate will rise to 2.8% the year after that, and really pretty much kind of stay there because that's where they think their stable long-term rate is. But I think there's something else they're doing which is vastly more important, and which is why I don't think there will be a 50 basis point rate hike in the next meeting, or that they need to. And that is what they've also said, which Powell has also said. And he talked about this a lot after he gave the introduction. When he talked about this a lot when he was actually talking to correspondents in 40 minutes after the beginning of the presentation. And that is what happens to the size of the Fed balance sheet. And he said that they did a lot. What you'll see in the Fed minutes in a few weeks' time is that there was a lot of work in this Fed meeting put into the program of running down the size of the Fed balance sheet. And what he said was that he expected this program would begin at the next meeting, and that it would be very similar to the structure of what happened before. And so what happened before was they stopped buying and they allowed the Fed balance sheet to run down. Now, I think firstly, what does that mean directly in the market? It means they've stopped buying all bonds, and they are not going to buy any more bonds for the foreseeable future, apart from just very slightly rebalance that balance sheet as they're allowing it to run off. And they're not buying any more asset-backed securities. And so what you've actually seen since then is a sell-off both in the US Treasury market, but also, more interestingly, you've seen a significant sell-off in US mortgage, 20-year yields. And you can see this happening if you look at the Federal Reserve Economic Database. You can see the long-term mortgages sell off. And really, and this is the other mistake made by aged commentators in the Australian, is that the way the mechanism of what the Fed does and the way Fed policy actually bites in the US is really different than how it happens in Australia. What happens is, as the Fed funds rate goes up, that number goes into trading algorithms, particularly for mortgages. So as short as Fed funds rate go up, what they generate is a higher equilibrium values for mortgages, and mortgages, long-term mortgage securities sell off, long-term interest rates or mortgage interest rates go up, and it's that actually drives the slowdown in the US economy. So if you want to understand the slowdown in the US economy, don't look at the Fed funds rate, look at the mortgage yield, and what you'll see is there have been significant rises of multiple times of what the Fed has done and what the Fed is likely to do in the next year and a half. And that's what's going to drive the slowdown in the US economy. So I think that what the Fed is doing is vastly more powerful than commentators understand. It's a lot more than just putting up rates. What it's doing with the Fed balance sheet is really, really important. And what the Fed is doing is much more powerful than commentators understand when somebody says that they should be putting up rates faster. It's not necessary. You'll see that action in the Fed balance sheet is going to really bite. And you'll see it really biting in mortgage interest rates, long-term mortgage interest rates in the US. And that's going to have a very powerful effect in slowing the economy and reducing inflation both next year and the year after. Any questions?